Picture two guys walking into the same Chase branch on a Wednesday morning. Same loan officer, same conference room, same scratchy pens. They're both buying a house on Maple Creek Drive. Same floor plan, same square footage, same asking price. One of them drives away paying $2,011 a month. The other one drives away paying $2,171 a month. They wave at each other in the parking lot. Neither one has any idea what just happened. Over 30 years, that $160 monthly difference cost the second guy $57,600 more for the exact same house, the exact same street, the exact same everything. And that's before we even touch car loans, insurance premiums, security deposits, and credit card rewards neither of them knows they're missing. Add all of that up across a lifetime, and the gap between these two men quietly crosses $400,000. Not because one made more money, not because one was sharper or luckier, because one had a three-digit number the other one didn't. And the bank that handed both of them their paperwork had absolutely zero obligation to explain the difference. My name is Smith, and I've spent years tracking money that slides out of people's wallets every single month without anyone explaining the transaction. If you've ever checked your credit score, seen something like 705 or 720 and thought, hey, that's pretty solid, this video was made specifically for you. Because solid is costing you a fortune. Let's get into the actual numbers. Before we talk money, we need to clear up a massive misconception, because most people were told that anything above 700 means you're in good shape. That's not wrong. It's just dangerously incomplete. 700 is comfortable. There's a massive financial gap between comfortable and exceptional, and that gap has a very specific dollar amount attached to it. The FICO scale runs from 300 to 850, divided into 5 tiers: poor, fair, good, very good, and exceptional. That's 800 to 850. The financial system's way of saying, you spent a decade doing everything right, so here's a slightly lower rate on a loan you still have to repay for 30 years. Romantic, right? But we work with the system we've got. Here's something most people never hear. 800 and 850 are functionally the same to lenders. Nothing is reserved for 850 that isn't equally available at 815 or 831. Once you cross 800, every door is open. The climb from 800 to 850 is basically a hobby. Impressive to talk about at parties, financially irrelevant. So where does 832 actually sit? The average American FICO score right now is 716. The median is around 745. Only about 23 to 24% of Americans carry an 800 or above. Roughly 1 in 4 adults. And 832 sits comfortably above that floor, somewhere in the 93rd to 95th percentile. Only 5 to 8% of scored Americans reach this level. A perfect 850, by comparison, is held by approximately 1.76% of consumers. About 4 million people out of 250 million scored adults. What makes this distribution genuinely unsettling is the shape it's taking. The middle range. Scores between 600 and 749 shrank from 38% of consumers in 2021 to 34% by 2025, while both the top and bottom tiers grew. America's credit landscape is splitting into a K-shape. The people at the top are pulling further ahead. The people at the bottom are falling further behind. And the people stuck in the comfortable middle, they're the ones paying the quiet tax we're about to calculate. Let me give you someone specific to think about. We'll call him Derek. Derek is 32 years old. He pays his bills. He's got 2 credit cards he doesn't max out, a car loan he's handling, and a FICO score sitting at 712. He thinks that's solid. And honestly, it is solid. It puts him right around the 55th percentile. The comfortable middle of the American credit picture. But comfortable, as we're about to see, comes with a price tag Derek has never once been handed a bill for. Hold on to this. 13 out of every 14 Americans are leaving real money on the table every single month without realizing it. We're about to find out exactly how much. And the mortgage number alone is going to stick with you. This is where a strong credit score does its heaviest, most expensive work. Using current 2026 rate data, here's what a $320,000 mortgage. That's 20% down on a $400,000 home. Actually costs across credit tiers on a 30-year fixed. An 832 score gets you approximately 6.44% APR. Monthly payment, $2,011. Total interest over 30 years, $403,000. A 700 score bumps your rate to about 6.65%. Monthly payment, $2,057. That's only $46 more per month. Until you multiply it across 30 years and realize you've handed the bank $16,500 extra for the exact same property. A 680 score is looking at roughly 6.82%. Monthly payment, $2,094. Total interest, $434,000. That's $31,000 more than the $832 buyer paid. For the same kitchen, the same backyard, the same neighborhood. A 620 score. Technically fair credit, above the FHA threshold, pays around 7.18%. Monthly payment, $2,171. Total interest across 30 years, $461,000. That's $58,000 more than the $832 borrower. Same house, same yard, same HOA, same everything. The only variable is a 3-digit number. $58,000, that's a loaded pickup truck. That's 2 years of in-state college tuition. That's enough to make a reasonable person sit in a parking lot, stare at their steering wheel, and seriously question their financial decisions for the last decade. But before you think $58,000 sounds significant but survivable, let me reframe it. That's $160 extra per month for 360 consecutive months. If you took that $160 instead and invested it at a 6% annual return, it compounds to roughly $183,000 over those same 30 years. The real cost of a 620 versus an 832 on a single home purchase isn't $58,000. It's closer to $250,000 in wealth you never build. On one home. And most Americans buy 3 or 4 homes across a lifetime. Take a breath. That's a normal response. Derek buys the house with his 712. His rate lands at 6.65%. He's paying $46 more per month than the 832 borrower and genuinely believes he negotiated well. He has no idea he just agreed to partially finance someone else's vacation. If you think the mortgage is the complete story, the next few minutes are going to be harder to hear, because the mortgage is actually the part most people have at least thought about. What they haven't thought about is the credit tax that follows them into transactions where they aren't even borrowing a single dollar. Let's start with cars. Say you're financing a $36,000 vehicle over 60 months with an 832, super prime territory. Your rate sits around 4.70%. Total interest over the life of the loan, roughly $4,400. At 700, that rate climbs to about 6.55%. Total interest, $6,200. At 620, you're looking at around 9.60%. Total interest, $9,200. The 832 buyer saves nearly $4,800 on a single vehicle compared to the 620 buyer. Across 6 to 8 cars over a lifetime, that's $30,000 to $40,000 from car financing alone. Gone, without a single missed payment or financial disaster, just a lower number. But here's where it escalates from a borrowing problem into something much bigger. In 47 out of 50 states, insurance companies are legally allowed to charge you more based on your credit score, not your accident history, not your speeding tickets, your credit score. California, Hawaii, and Massachusetts looked at this practice and said hard no. The other 47 states looked at it and said sounds perfectly fine to us. So if you live outside those 3 states, you're paying a credit tax on top of your car payment. And nobody mailed you a memo. The numbers are jarring. A driver with exceptional credit pays an average of $1,680 per year for auto insurance. A driver with very poor credit pays $6,300 per year. Same driver, same vehicle, same commute, same claims history. The only difference is the credit score. The annual gap, $4,620. That's $385 every single month for driving the exact same roads. Derek pays about $2,450 a year for auto insurance with his 712. He thinks that's normal. Because it is normal for 712. His neighbor with an 832 pays $1,680. Derek is sending $770 extra every year into the insurance company's pocket simply because of where he sits on the credit scale. It comes out of his account automatically, feels like a utility bill, and nobody ever connects it back to his credit score. Over 40 years of driving, that gap before a single investment calculation adds up to more than $64,000 in extra premiums. And we haven't touched homeowners insurance yet, which runs the same system, or utility deposits. Yes. Your electric company checks your credit, your phone carrier checks your credit. With an 832, those deposits disappear. With a 620, you're handing over $200 to $750 before a single light turns on in your new apartment. The lifetime total cost of poor credit versus exceptional credit? Researchers put it at approximately $398,000. That's 9.4 years of median full-time earnings bleeding out quietly, month by month, and slightly elevated payments that feel completely normal because they've always been this way. Let's talk about what shifts when you actually reach this number. Because it isn't just the rates, it's the entire texture of every financial option available to you. Premium credit cards, the Amex Platinum, Chase Sapphire Reserve, Capital One Venture X. These products exist in a completely different universe from secured cards and 29% APR offers. Welcome bonuses worth $1,000 to $2,500. Cashback rates of 2 to 5%. Airport lounge access, travel credits, rental car insurance. The average 800-plus score holder generates $500 to $2,000 per year in rewards. Money that people with lower scores simply cannot access because they can't qualify for the products. Credit limits. A lending tree analysis of 100,000 consumers with scores above 800 found their average total available credit was $73,000. The national average sits around $30,000, more than double, which means that even if 800-plus holders spend the same dollar amount as everyone else, their utilization stays dramatically lower, which keeps their scores high, which keeps their limits growing. The system rewards you for already being positioned well and makes climbing from the middle harder. It's not rigged exactly, but it is deeply self-reinforcing. Housing. In competitive rental markets, landlords receive 30 to 50 applications for a single unit. And 832 doesn't just clear the bar. It ends the conversation. Security deposits are waived. Sometimes the first month is negotiable. Meanwhile, the 620 applicant is competing for listings that weren't anyone else's first choice. Employment. Roughly 51% of employers in financial services, government contracting, and security-cleared positions run credit checks during hiring. Poor credit doesn't just cost you money in those fields. It can cost you the job entirely. There is a genuinely alarming amount of wrong credit advice circulating out there. Some of it has been costing people real money for decades. Myth 1. You need to carry a balance to build credit. This is the most expensive credit myth in American personal finance history, passed down through families with the confidence of established fact. It is completely and totally false. It has always been false. Somewhere out there is the person who originally started this rumor, and they have personally caused millions of Americans to hand free money to credit card companies for absolutely no benefit. What your score actually measures is that you use credit and repay it, not that you pay interest on a lingering balance. Pay your full statement balance every single month. That's it. Myth 2. Closing old cards you don't use is responsible financial hygiene. Closing an old card reduces your total available credit, raises your utilization ratio, and trims your average credit age. All three of those things hurt your score. Leave old cards open. Put a small recurring charge on them. A streaming subscription, whatever. So the issuer doesn't close them for inactivity. That's the complete move. Myth 3. Checking your own score damages it. There are two types of credit inquiries. Hard inquiries. When a lender pulls your file for a loan decision. Cost roughly 5 points each. Soft inquiries. When you check your own score, have zero impact. Check it every week if you want. Check it every day. It doesn't move the needle. Myth 4. Your income affects your credit score. It doesn't. Income doesn't appear on your credit report and is not a FICO factor in any way. A person earning $38,000 a year with disciplined credit habits routinely outscores someone earning $380,000 who mismanages debt. The score measures behavior, not earnings, not wealth, behavior. Myth 5. 850 is the goal. It isn't. There is zero practical difference between 832 and 850. No product, no interest rate, no tier exists that's available to 850 holders, but not to someone at 831. The full benefits of exceptional credit unlock somewhere around 760 to 800. Everything above that is the financial equivalent of scoring 103 on a test graded out of 100. You can do it. It demonstrates something. It just doesn't get you anything extra. FICO's formula isn't a secret. Here's exactly what it weighs. Payment history. 35%. Credit utilization, 30%. Length of credit history, 15%. Credit mix, 10%. New inquiries, 10%. Payment history and utilization together account for 65% of your total score. And both are things you can act on right now. Getting from 700 to 750 is about elimination, not construction. Get your utilization below 10% by paying your balance before the statement closing date, not the due date. That distinction matters because the closing date is when the balance gets reported to the bureaus. Set up autopay on every single account. Pull your free credit reports from all 3 bureaus at annualcreditreport.com and look for errors. Millions of Americans have inaccurate negative information dragging their scores down, and disputing it costs nothing. Stop applying for new credit while you're in this phase. Timeline, 6 to 12 months. It's not exciting, it's infrastructure. Getting from 750 to 800 is optimization plus patience. Push utilization below 7%. The average among 800 plus score holders is 5.5%. If you only have credit cards, consider adding an installment loan to diversify your credit mix. Stop opening new accounts and let existing ones age. One counterintuitive detail worth knowing: scoring models reward 1% utilization on one card slightly more than 0% across all cards. The algorithm reads 0 utilization everywhere as potentially dormant credit. Leave one card with a small balance when the statement closes. Timeline, 1 to 3 years. Getting from 800 to 832 is almost entirely about time. The average 800 plus score holder has maintained their oldest account for 23.3 years. No strategy shortens that. Use the AZEO method. All 0 except one card at 1 to 3% utilization, all others reporting 0 when statements close. Keep 8 to 10 open accounts in good standing. Never miss a payment. Apply for nothing. And wait. You cannot hustle your way to this tier. The clock is the primary ingredient. One critical warning. At 832, a single missed payment can drop your score 50 to 80 points. The model sees a severe deviation from a pristine pattern. The higher your score and the cleaner your history, the harder a miss hits you proportionally. Autopay isn't optional at this level. It's the foundation everything else sits on. This might actually be the most important thing in this entire video, because everything up to this point has been about getting to 832. What I want to talk about now is what happens after. There is a trap waiting on the other side of this achievement, and the financial industry has absolutely no incentive to warn you about it. A high credit score is not the same thing as financial health. Confusing those two things can unravel you just as quietly as having terrible credit. When you hit 832, banks offer you enormous loans. Mortgage brokers show you the maximum you qualify for. Credit card companies send premium offers with high limits and competitive rates, all of which we've spent 20 minutes establishing as genuinely valuable. But the system is built to help you borrow more, not to help you decide whether you should. This is where someone reaches 832, gets approved for a $650,000 mortgage, finances 2 vehicles, opens 4 premium cards, and posts something about financial freedom. Their credit score is exceptional. Their net worth is barely positive. They've used excellent credit to build the world's most expensive-looking illusion, and it holds together perfectly until someone loses a job or a medical bill shows up. You can carry a perfect 850 credit score and negative net worth. The score measures how responsibly you manage debt, not whether you've built actual wealth. Think about this. Someone with $1.2 million in index funds and no credit cards scores lower than someone barely keeping up with an over-leveraged mortgage. The FICO algorithm has no idea who's actually winning. It only sees the debt management patterns. Real financial health uses the credit score as a tool, not a scoreboard. The goal isn't to borrow as much as possible at the best available rates. The goal is to have an 832, live below your means, invest consistently, and occasionally deploy that score to get the best possible terms on something you've already decided you genuinely need. The score is the instrument reading. The wealth is the destination. Don't confuse them. So, here's where we actually land. 832 is a number most people treat like a grade on a report card they barely glance at, when it's actually a financial instrument that pays out for decades. On a single home purchase, the gap between 832 and 620 costs $58,000 in additional interest, or closer to $250,000 in wealth never built once you account for what that money compounds to. Across a lifetime of car loans, another $30,000 to $40,000. Auto insurance alone, $4,600 more per year, $64,000 plus over a driving lifetime. The total lifetime cost of poor credit versus exceptional credit approaches $400,000. Not from any single financial disaster, from slightly higher rates, slightly larger premiums, slightly worse terms, quietly compounding across decades in payments that feel completely normal. And the path there doesn't require a high income, an inheritance, or a finance degree. It requires understanding 5 factors, automating your payments, and having the patience to let time do what only time can do. What it does require is treating your credit score not as a vanity metric, but as the financial infrastructure it actually is. Build it deliberately, protect it seriously, deploy it intentionally. Not as permission to borrow more than you need, but as a tool that permanently lowers the cost of everything you'll ever finance. 832 doesn't make you wealthy by itself, but it changes the price of everything. And over a lifetime, changing the price of everything adds up to a number that should make every single person watching this pause and honestly consider where they sit on that scale right now. Derek still has a 712. He's still comfortable, he just doesn't know yet what comfortable is quietly costing him. Now you do. Drop your current score in the comments and tell me the single biggest thing that's in the way. I read everything. I'll see you in the next one.